Can everyone see the screen here?
Yes.
Yes.
Excellent, thank you. Right, I'm just making, oops, there we go. So, yep, today we're talking about spotting scams. I think most of us, regardless of where we work, have known someone who's been a victim of a scam or fraudulent investment. Obviously, these days we're inundated with all these fraudulent emails, WhatsApps, and all the rest of it. Today, I'm going to be focusing more on the investment scams rather than scams where they're trying to capture your data and blackmailing and all that sort of thing. It's very specifically about how you can arm yourself with knowledge on avoiding investment scams. So for those of you who don't know me, a very quick introduction. I've been in the UAE for about 22 years. This is actually my 23rd year. I'm now part of the Lawson's Advisory Network, which is an independent network which suits people like me who've come from bigger institutions and larger firms who now want to work on their own terms, shall we say. And most importantly, I'm a husband, father, and an avid science fiction fan. So I welcome questions about science fiction as well. Excuse me. So a bit about terminology first, definitions, very important. A scam is a fraudulent business scheme. It's a deliberate attempt to swindle you, to take your money and run off with it. There's usually no end benefit for the person who's being scammed, although some scams are very complex, and in the early stages of scams, people can actually make money from them. And that brings us on to a quick case study, which is Bernie Madoff. I don't know if any of you know of Bernie, but he ran one of the largest and most famous Ponzi schemes in history. He was a well-respected, well-regarded financier, and he was running his scheme for at least 25 years. He swindled something in the range of $65 billion. And the Ponzi scheme, of course, comes from Charles Ponzi, who ran a very similar scheme where people are putting in money and you're paying the investors from the money that people are paying in. But the interesting thing to note about Madoff is that he was an industry veteran. He advised the SEC, which is the US regulator. He actually helped launch the NASDAQ index as well. So scams can come from anywhere. They're not always unsophisticated, easy to spot things. They can often be wrapped up in excellent reputations and excellent knowledge of the industry. There's a number on the screen there, which I hope you can see, 33 billion. This is an estimate of what's lost annually to investment scams around the world. Now, the figure is more of an estimate in some cases because a lot of scams go unreported. Some of them are very good at simply vanishing into the night, and they're not reported to regulators. So the true number could be a lot higher. And that's why we're here today. We're here to make sure that your hard-earned money is not part of that 3.3 billion. So to come back to definitions, again, very important. There's a lot of overlap between these three things, between what is a scam, what's actually just high risk, and what could be a case of mis-selling. High risk stands on its own from the other two. It can simply be an investment that doesn't have a good chance of working, or that could take a long time before you got your money back. But it doesn't mean it's fraudulent. It could simply be either badly run or engaged in markets or activities which have a high probability of failure. But they could be run with all the right intentions, run legally and properly. Mis-selling, on the other hand, feeds into both of these. And most people that I've met over the years as a financial planner have dealt with mis-selling more than scams, I would say. Mis-selling often comes in the form of an advisor giving somebody the wrong product, effectively the wrong solution, which can turn out to be high risk. And sadly, in some cases, some scams are so well hidden that even legitimate advisors don't know they're selling them until it's too late. And I actually have personal experience of that with a firm I worked for just over a decade ago, where there was an Australian land development, which the people selling it were claiming was fully regulated. Turns out it wasn't, and people lost a lot of money. But that ran for many, many years before there was a problem. So let's look at some of the red flags, some of the warning signs of what could be a scam. But at the same time, what I'd like to do is give you also another perspective in that a red flag may not be a scam. It could be an indication of simply high risk, or perhaps even the enterprise itself is just not very well run, which sometimes happens too. So one of the main things with most scams is, because they want your money and they want it very badly, is they tell you that there are promises of very high returns with little to no risk. Now, of course, anyone who's got an experience with business or investments knows that all investment carries risk, and risk needs to be mitigated. And really the only way to mitigate risk is to do your homework, or in some cases, let's say, for example, with the major stock markets, it could just be a case of having to wait longer before you take your money out. But that's often a very big promise. But again, this can also be a sign of mis-selling. A bad advisor could just be telling you that something has high returns with no risk, when in fact it doesn't, but it may not be a scam. But it's important to be aware of this. This is always a red flag when anyone tells you this, regardless of whether you suspect it's a scam or just simply a high-risk endeavor. Excuse me. Something else to consider is the person you're dealing with. The lack of qualifications and or experience can be quite a major sign of a problem. However, I'm going to give another viewpoint there as well. I do know personally a couple of advisors who've been working in the offshore market for a good 20, 25 years, and they're not as qualified as I am, yet I would trust them with my own money implicitly. So it's not always a sign, but I think 9 times out of 10, when somebody isn't fully qualified and doesn't have experience to back that up as well, that's a red flag for you to be considering. And another thing, which is usually a sign of mis-selling, not of scams, but again, the two are interchangeable, is you're being pressured into making a quick decision. And I don't mean, for example, you've sat with an advisor or a sales consultant of some kind, you identified a clear need, you've been presented with 1 or 2 options which fit those needs, and you've done your due diligence and you're happy with them, but perhaps for one reason or another, you're just delaying a decision. But I'm talking about when people are not giving you the full information and asking you to make a decision right away, sometimes at the same time that you're speaking, that they're presenting to you. That's always a red flag as well for me. The most famous, let's say, marketing technique for financial planners in the offshore market for many years has been cold calling. I'm quite proud of the fact I've never done it myself, and I never intend to do it. I think it's a very old-fashioned and low return, high time endeavor activity. But often with a lot of the kind of boiler room setups, they get a bank of people just calling, and it's a numbers game. They call enough people, somebody will stay on the phone, they'll listen, and they can pitch whatever it is they're trying to sell. And this can be one of two things. Again, it can be fraudulent, or it could just simply be a high risk investment. Perhaps it's something that's paying the advisor or the salesperson a lot of money, so they're incentivized to, get their numbers up as well. I think in any case, most people these days, and I've certainly seen this trend in the market, don't respond well to cold calling anymore, and to unsolicited text messages and things like that, which I think is an excellent thing. We have LinkedIn, we have networking groups, we have so many other ways of finding a market for our clients that we shouldn't have to be cold calling people. So generally that's a sign that something is off, not necessarily a scam, but definitely something's going on. Of course, another thing that we see is using the lure of being part of an exclusive club, something very special. I think we all like to sit in first class or business class. We all like to know that we're doing something that's a little bit special from everyone else. And a scammer will, if they're well funded, and many of them are, will capitalize on that. Some of them come into markets with a big fanfare. They will spend a lot of money. They'll get very nice offices, and they'll run their various schemes for a number of years, and then suddenly one day everything's gone and closed down. Now, of course, that doesn't mean every gala dinner, every presentation is a scam, but it's often a tactic that's used by many scammers. The Bernie Madoffs of the world, as we went through earlier, certainly somebody who used his prestige and the fact that he was part of an exclusive club. He was a Wall Street insider. He was one of the founders of the NASDAQ. And that lured in a lot of people with a lot of money who often had very good advisors, wouldn't see through that. And another big thing with the scammers often will do is they won't be able to explain to you clearly and simply where the money's going, how it's deployed, and how the returns are generated. Now, with a few exceptions, most investments are not that complicated. and can be explained within a few minutes by any competent financial professional. They should be able to tell you where your money's going. They should be able to tell you how it's deployed and how the business or the enterprise in question is generating returns. Many of them, the good ones, will be even more transparent and tell you what their profits are versus what they're sharing with you and things like that. When they can't clearly explain this to you, that's a major red flag. And even if it's not a scam, a fraudulent scheme, it could be a sign that the person you're dealing with is not a competent advisor or a salesperson. And that's also a sign of maybe you should be doing business with them, or you should seek a second opinion. And of course, if you do your homework on some companies and individuals, you'll find sometimes, especially these days with the internet, that some people have got many red flags against their name. Some people have gone through litigation. Some people have even served time in jail and been convicted of various crimes. And that, of course, is a sign that perhaps they're not worth doing business with. This is particularly important when you're dealing directly with a company to invest your money directly with them. Most people invest in things like stocks and property. So with stocks, you're tending to buy into indexes or to major companies. So all that knowledge is public. It's very easy to find out who the CEOs are, who the finance people are, how long they've been running. But if you're going for maybe a boutique investment, a smaller company, you really have to do your homework on who's behind that company. In many cases, who's running the company is more important than the actual industry it's in and the market it's in, because good leadership can take companies through good times and bad times. Unfortunately, and I hate to say this because I'm a firm believer in regulation, regulation is not always protection. And the example I gave of Madoff earlier was a classic example of that. He was convicted in 2008, I believe. But as early as the early 1990s, there were people in the industry who were raising red flags with regulators. And because of Madoff's sterling reputation, that was downplayed. People were told not to say anything, don't worry, it's all okay. So your first line of defense always has to be you. It's always got to be your best judgment. And if that means that you have to take a bit more time to read through documentation, you have to go online, do your research, ask around, then so be it, because we're talking about your money here. You can't take risks with that. All of us have are working for a living, unless there are any politicians here, of course, which I don't think there are. So we have to really make sure that our money is being used in the best and wisest way possible. And the main question that I get when I get asked about this is, how can you protect yourself? Well, first and foremost, with investment decisions, and I do mean specifically about when you're at the point of making a decision where to deploy your money, make that as emotionless as possible. Don't get caught up in hype. Don't get caught up in how exciting it is. And it can be very exciting, particularly when you're investing in something for your goals so that you can hit those important life goals. Take a step back, take a breather, look at it dispassionately. If you need to take a bit more time, take a bit more time. And as I mentioned, goals. If you're focusing on goals when you're investing, that will normally reduce the impact or the risk of you getting involved in fraudulent schemes, because every goal you have will have a time frame and it will have an appropriate investment for that goal. As an example, if I'm retiring in 20 years, then I've got 20 years to invest my money, which is a long time if I'm looking at the stock market, if I'm looking at property. If I'm retiring in 2 years and I haven't deployed my money yet, then the stock market is definitely not a good idea unless I'm willing to accept that I could see a major loss before I see any recovery. And property, depending on how you invest in property, is also not a short-term goal as well. So I may need to look at other things instead. So once you've framed why you're doing what you do, it almost becomes automatic that the kinds of investments that are appropriate for the time frame, for where you are in your life, they kind of slot into place. And usually that means then that you're less likely to get caught up in the hype of a new scam or some new thing that's come out that's actually not suitable for what you want to do. And of course, you've got to do your due diligence. You have to read the fine print. It amazes me over my career how many people don't read the fine print. Many people trust me to just give whatever I recommend to them. They just do it, which is great. It's a massive compliment, perhaps the biggest compliment anyone can pay me. But it also makes me realize that if somebody trusts somebody or somebody seems to be trustworthy, it's very, very easy for them to skip over the the proper steps, which is please read the paperwork, have a look at it over the weekend, come back to me with any questions, and just get things signed up, and off they go into the dark of night, as it were. Most importantly, and I'll leave this as a final point, ask questions. As I mentioned with some of the red flags earlier, there are a few things you can do which would immediately, let's say, strip away many of the less sophisticated fraudulent scammers are out there. And that is, where does my money go? How are the returns generated? When can I get my money back? What are the terms and conditions? Who's in charge of this? How long has the company been in business? All these sorts of questions. If you have these questions in your mind when you're speaking to people and they can't answer them, or follow up with an email and give you all the information you need, then it's probably not something you want to be involved in. And with that, as promised, I'd like to end there. Very quick and very hopefully very succinct, let's say. I'm going to stop sharing the screen now.